So that said, just basic info about myself. My name is Hovig Khachadourian. I'm actually the lead trainer and the underwriter here at LBC Mortgage. I'm a CPA by background, but I've got two passions in the business. One is the mortgage industry, and the second one is market analysis, technical analysis, and day trading. And those are the two areas we'll be covering today. And hopefully they will add value to your knowledge to make better decisions for your 2022 and beyond business. So, and that's very simple. I don't want to go more detail about myself. What we'll cover today is just how the industry has been evolving and changing, what alternative products and avenues are available for homeowners and realtors, and how we can all benefit from those going forward the next 6 to 12 months, and how the market in terms of rates going to be shaping up going forward the next 6 to 12 months. On my last seminar, I actually covered the market in terms of the rates. And a lot of people were asking, they had a lot of questions. So what I want to do, I just want to take about 10 to 15 minutes and cover that at the beginning. And I think that's going to give us the base of what we're looking when it comes to the market. And then we can add on top of that based on the products and the opportunities and so forth. So I'm going to share my window. Just quickly, when I say my passion is market analysis and day trading, I actually have spent many years and thousands of hours analyzing charts, learning technical analysis, charting the market actually by hand. So I've really studied in detail different scenarios, different situations where the market is ripe for a change. So, and that's what I want to cover today. And of course, there is no guarantee. And whatever I cover when it comes to the market and the rates and the bond market, it's explicitly for educational purposes. Please do not go out and trade accordingly. This is just for educational purposes only. I had to put that disclaimer on there. All right, so I'm going to bring the charts, and we'll go over that for about 10-15 minutes, and then we'll go over the rest of the presentation. Can you guys see my the chart here? Let me minimize this. Are you guys able to see my my screen? Okay, perfect. So I'm going to minimize this webinar thing, and then let's focus on this chart. What you guys have in front of you is the 10-year Treasury note monthly chart. So each one of these bars are represented as per month. So what I want to cover is how the rates are associated with this market and how they are shaping up to which direction they're shaping up to go. Most of the 10-year, the mortgage industry is governed, or the rates are governed by the 10-year note, not the 30-year bond market. Although if I put the 30-year bond market chart on here, it will look exactly something like this. But for our purposes as mortgage brokers and mortgage consumers, we want to focus on the 10-year note. You don't really need to know much, and I'm going to just cover the basics on this. One of the things that you need to understand is that the price of the bond market and the mortgage rates have an inverse relationship. If one goes up, the other one goes down. So that is why, if you see on the left side of the chart right here, from 2007 all the way to 2012, the bond market prices were going higher. That's when we had some great mortgage rates. The mortgage rates were going lower, right, for almost 5 years. So as the bond prices go higher, mortgage prices go lower, or the mortgage rates go lower. The second thing that we need to understand about the bond market and the mortgage rates, specifically the bond market is a very slow-moving indicator. What does that mean? It means that it doesn't go from, let's say, $90 to $140 overnight or in like a couple of weeks or so. It takes weeks, months, sometimes years. And in this case, for example, if you could see from 2007, we went from 103 all the way to 135, 136 area. So that took like almost 5 years. And then we had few years of consolidation, and in between we had some years that the rates were good. Like, for example, in 2016 we had some pretty good rates, and then rates started going higher again. And then during the height of the pandemic, the 2020, early part of 2020, we had about 6 or 8 months of good mortgage rate opportunities. And that's, let me expand this, that's right here. That's the high of 2020. So all this information probably does mean nothing to you guys. What really guys interested is where to from here. So we're going to be focusing on this last part right there. Okay, I actually had these yellow boxes here months in advance, and those were my support levels. I had projected that the bond market, the prices of the bond will come down to first 123 area, and then they will find support there or break through it. In our case, they did break through it, as you can see. And the next support level was at the 117 area. So where right now, that's where we are. Okay. So if you guys could see right here also, the reality is that the mortgage rates started their uphill climb and starting like around third and fourth quarter of 2020. So because the bond market has been going down since then. And the fact that we're hearing a lot about the mortgage rates the last couple of months is because of these two big bars right here. Remember I said these are two monthly bars, and usually they're pretty small if you look at it. But look at April and look at March. I mean, they're almost the market. There was a huge sell-off in the market called market capitulation, and that was mainly because of the Federal Reserve came up and stated that they won't be buying any more bonds. They're tapering, and then they're starting to raise the interest rates and all that. So the market is going through a shift right now. So that said, where are we right now? Where do we expect, or where do we see, or where are the probability for the rates to go? My projection, where I look at it, I think, and there are also two external factors we will talk, but as I look at this chart, I think the bond market will find support at this 117 area. There's about 40%, 45% chance that it will find short-term support around this area, the 117, and the rates, especially the conventional rates, will stabilize. We're not going to see like 3% rates anymore soon, but at least they won't go to 6% if it finds support here. Again, the probability for it to find support around this area is about 40-45%. If I change this to the weekly, we can see it's finding support there. And if I change to daily, I am actually closely looking at these bars here this week and next week and see if we're going to find support here. So, and I said there are two external factors for this support to either break or hold. What are they? One is the FOMC meeting next week. And the second is it's an external factor. Again, it's the war in Ukraine. So I think it should hold. And if it does, and that's going to give us the opportunity to, have the bond market is going to climb higher. It's our rate's going to be maybe in low 4s and high 3s for the conventional for the short period of time. Or if it breaks, which the probability for it to break is a little bit higher, it should go down to this area, to this box. And if that's the case, then we're going to unfortunately start seeing conventional rates in 6s. Okay, so we are almost there, but 6 to 7, it's going to be a normal for conventional rates if it breaks the 118 support, 117 support area. Okay, and I'll update next week in terms of what's going to happen. I usually let the market tell me what's going to happen. Those are projections. Those are forecasts. We can't really predict because we don't know what's going to happen with the Federal Reserve's decision making or the war in Ukraine. But based on the charts, this is where we are right now. Those are the two options. Now, most quickly, I want to cover the Federal Reserve rate increases. Most people think that the overnight rate increases by Federal Reserve, it's going to affect the mortgage market. In my opinion, in what I've done, I've been in the business for a long time and I've done the charting and the stuff here. When the Fed starts raising the overnight interest rates, it's actually good for the mortgage industry when it comes to rates. The only thing that the overnight rate or the Fed mortgage rate increase affects is the non-QM market. It doesn't really affect the conventional market. So there's a huge misconception about that. So that's why we see in the non-QM market, a non-QM market that we're going to be talking about right now next is those are the bank statement programs, stated no doc type of programs, for example. Those are affected by the overnight because those are investor-related transactions. So, okay, so I want to bring that in. So to summarize, if the market holds at this level, we will have a little bit of lower rates going forward, short period of time. If it breaks this level based on next week's Federal Reserve meeting, then we will have rates in 6 to 7 areas. Okay, I'm talking about the conventional rates. All right, so that's one more thing I want to bring here is the 30-year the interest rate chart. This is actually the interest rate chart of the 30-year mortgage. And if you guys could see from 1980 on, it's been going down and down and down, okay? And it's basically bottomed in 2020 during the pandemic, and it's been climbing higher. One of the things that concerns me is this high here is about 4.85, and the high here actually broke, which is about 510. It broke this high. And from the technical perspective, that's not a good sign. Now, there's one little positive in there is that it's 4.85 and 5.11. There's not much of a big difference. We can even call that a double top, but I will let the market show me what that is rather than me predicting, oh, is this going to go higher or it's going to reverse, okay? And the market's going to tell us, I believe, next week, okay? So, and well, if you guys are interested, I could send you guys an update on that. You guys could email me, get on my list, and we'll update you on a regular basis. So that's it for the bond market and the rates. Okay, so right now, one of the things that's happening in the market is, of course, the change. There is, and the mortgage industry always does go through these changes all the time. And we as professionals, our job is to educate our partners, our clients, and so that we are all ready to take advantage of the opportunities that's going to come up eventually, or the next 6 to 12 months. One of the things about mortgage we always tell our clients is you have to plan your mortgage journey. You can't just jump into the market and expect to get a mortgage overnight unless you're getting a cash purchase. In that case, you're not going to have a mortgage. But if you're looking for a mortgage, our number one advice is to plan your mortgage journey. Okay, and what does planning your mortgage journey mean? Planning mortgage journey is working with your realtor partners to see how the market is. Secondly, working with your mortgage partners or mortgage loan officers to find out how much you could qualify for, what you could qualify for, what type of programs you could qualify for. And again, this is a communication between realtors, mortgage loan officers, and you. So, and the more planning you guys do together, the better outcome you will get down the line with your purchases. And one of the things of the mortgage transaction is it does take time. There's a lot of paperwork involved and stuff. So when you plan ahead, the process will make it much, much, much easier. And we, on our end, we have done our job to make it easy on your end, so that way you have less stress. Like for example, at the end, I'll let you guys know how we have a portal. We've created our own CRM system where we have an agent portal and we have a borrower portal. So you're always constantly getting, let's say your loan started, you're always constantly getting updates on that, clear communication, or let's say you're in a pre-approval stage, you've approved and you're still looking for a property, 60 days or 30 days have passed from the pre-approval, you'll get communication stating that, Mr. So-and-so or Mrs. So-and-so, we need updated pay stub to update our file, so that way we're up and running and ready when the time comes to put an offer. Okay, so that's one of the key advice I could give you guys today in terms of we've called this mortgage masterclass. If you could take that one point, that's a great point to take with you. That's what I want to cover is some of the products that are available today in the market that it's going to give us opportunity as a mortgage professionals and mortgage consumers to take advantage of the market. Okay, the market is going to come back. It's the mortgage industry, mortgage market. It's always evolving. It's going up and down, up and down. So if we know that, we can let the fear out of our system and focus on the opportunities and make better, intelligent decisions accordingly. So that said, let's cover what are some of the products that are going to add value going forward. We know we have the conventional market. That's there. We know we have the FHA market. That's there. The rates, yes, they're gone higher, but they're still available. We actually I'm going to be doing another webinar on zero down FHA and the conventional loans, where we put nothing down except you got to have the closing costs and sometimes reserves too. So those products are available, although in Los Angeles County sometimes it's not as accessible as possible because of the prices, but the product is there. So that's for owner occupied. I'm actually putting together a webinar for that. Okay, so alternative products. What are alternative products? Alternative products are basically the way I want to explain it is we still need certain documentation, but the ability for the borrower to pay the mortgage back is calculated differently or using different documents than traditional W-2s, tax returns, and so forth. Okay, so that's mainly the alternative documents. The alternative documents, again, the main thing to know is we still need to calculate the borrower's ability to pay, but we are calculating them based on different documents rather than traditional tax returns, pay stubs, W-2s, and all that stuff, or commission. So, and what are some of those alternative documents? For example, we can use business bank statements or personal bank statements, 12 months of bank statements to cover those. There are about 8 or so products, and I want to 8 or so different products, but we want to focus mainly on the ones that that's like the majority of the market is focused on, and that's where the consumer, as you, getting most advantage of. One of the products is, of course, the bank statement products. The second, and we'll talk a little more detail on each product. The second one is the no doc, where really we don't need any income documentation, no income information on the application, nothing. So the other one, I've called it limited docs, that we need certain items from you, but again, it's extremely doable. Then the last one that we're going to be talking about, it's called debt service coverage ratio. That's for investment property. That's basically where the rent covers the PITI, or principal, interest, tax, and insurance, and then you could get a loan based on that. That's how you could calculate ability to pay. But on the DSCR, the ability to pay doesn't come into play much because it's not governed by the CFTB. All right. So a few other products that are we've been doing it on this that's opening up market. I-10 borrowers who have no green card and no citizenship or anything, but they do have an I-10 number. That's been doing great in today's market. That has opened up a lot of opportunities for these borrowers to get into the home market. So if you are an I-10 borrower, talk to us. We have programs. We have for you, and you can actually get into your dream home. So the other one is the asset-based loans. Basically, we take the borrower's assets and utilize them as income by multiplying or dividing in certain numbers and then coming up. That product is advertised a lot, honestly, but it's very minor portion of the non-QM market. Okay, and then the jumbo products and jumbo loans with 10% down. That's part of most of these programs. The bank statement, no doc. I mean, they could go up to $3 or $3.5 million loan amount. So those are the jumbos. The bank statement is the only one that's going to go with the 10% down. The no doc, limited doc, they don't have the 10% down. Okay. One other thing I want to emphasize regarding the alternative products. The alternative products are, like I said, they're based on ability to pay, and we need to figure out 3 factors when it comes to alternative products. The first thing is borrower's FICO score. The second thing is loan to value, meaning how much of a loan you're getting compared to the purchase price, or in this case, if it's a refi, the appraised value, okay, the percentage of that. And the third one is assets, reserves. So yes, we're not looking at your income, but we need to have good FICO, decent FICO at least. Ideal FICO is on this product. There are some products that go down all the way to 640. Ideally, or the sweet spot, you want to be 680 and above. In fact, 700, 720 and above is the sweet spot. And you got to have assets, okay? So I just wanted to keep those in mind. Those 3 things are a major determining factor when it comes to non-QM products or alternative products. All right, so a bank statement program. What are the bank statement program? We do a lot of these programs, and unfortunately, a lot of people do not understand the parameters for these, and they leave a lot of opportunities on the table and walk away. The bank statement program is basically if a borrower is self-employed, for example, and they've been self-employed for 2 years, We've got programs where they have to be self-employed for 18 months only, but on average, they have to be 2 years. We take their 12 months of bank statements. We calculate their monthly income based on their monthly deposits for the average monthly deposits for the 12 months. Now, there are certain parameters in terms of which deposits are used and which not. But in general, most of the deposits are used. But if you're getting, for example, if there's a transfer from a personal account to business account, we cannot use that. So again, we take the average of the 12 months of the deposits to figure out the income, and then we take 50% of that income because we use 50% of expense factor to utilize that income as your monthly income. Meaning, for example, if your average monthly deposits come up to be $100,000, we take 50% of that, $50,000, and that's your monthly income on the application. Okay. Now, in certain cases, we can go lower than, lower than 50%. For example, if you're a realtor, you don't have a lot of expenses. Most of it, your commission is coming. Your expense factor is probably 20 or 30%. So we can use, let's say, 30% of expense factor and use 70,000 of income per month rather than 50,000. In order to do that, though, we would need a letter from your CPA or tax preparer stating the expense factor on your end. So that's one of the things. And this is where the planning that I mentioned earlier comes into play. The planning is just, when we analyze the bank statements, we're going to be telling you, okay, we need this, we need that, you need to do this. Planning is crucial in the mortgage journey. Okay, so that's basically the bank statements. A couple of more things about the bank statement. Again, we talked about a little bit about the eligible deposits. Transfers are not eligible deposits. Deposits from EIDL or PPP loans are not eligible deposits. The deposits from personal friend or cash deposits, sometimes large cash deposits, you have to source them. You have to figure out where they're coming from. So again, this is where the planning stage comes. So you have to be aware of that. You can't just come in and deposit money into the bank and then boom, want to get a mortgage. I mentioned that you have to be self-employed for 2 years, although we've got programs that you could only be 18 months. And the ability to pay is based on the average monthly deposits multiplied by the expense factor. All right? Any questions? Let me know about the bank statement loans. I guess I've put this again. We can go up to 90%. Minimum FICO, we can go down to 640. Ideally, we want to see 680 and above to get the better rates. Remember, I said these programs are based on assets, FICO, and LTV. The lower the LTV, the more reserves or assets they're going to require. Okay, so just keep that in mind too. We can go up to debt ratio of 50%, loans up to $4 million. And these are available for all primary, second home, and investment options, okay? The next one that I'm actually, one of my favorite loans, how fast can you close on the bank statement loans? Okay, I've got a question. It says, how fast can you close on the bank statement loans? Right now, if we've pre-approved the borrower in advance, we can close it within 30 days or less, okay? Because we actually are approved and work with about 40 different lenders. So we on a daily basis, we're looking at each one's turn times and stuff. But we can close, again, if we've done our job up front and pre-approved the borrower, we can close in 30 days or less, okay? In terms, what's the best rate program on non-QM loans? Is asset base better than the DSCR? I like DSCR better than the asset base, to be honest with you. Unless the asset base really qualifies, but DSCR is really easy loan to do. It closes fast. There's not much calculations involved. With the asset base, there's a lot of documentation that the borrower needs to provide and support. Okay. In terms of rates, we'll talk about rates. I've got a couple of slides and had my assistant price few loans for us, so that way we could look at the rates. But so I don't know today's rates, to be honest with you. A financial assistance for first-time home buyer, that is not available on the non-QM products. That's only available on full doc conventional loans. Remember, I said I'm going to be doing a seminar regarding no down payment programs. That's where the financial assistance is, where we'll talk more about it again. But you get, let's say, 97% conventional loan and 3% financial assistance. Usually, there are different options. One of them is you get a 3% loan, but it's non-payable loan, where after 3 years or so, that loan will disappear from your mortgage. Okay, but we'll focus on that another time. If you email me, we could do discussion on that separately as well, Jose. Okay, so the no doc loans are these are. They're no doc. We're not asking for any income documentation. In fact, application, there's nothing on the income section. Now, knowing that, of course, the lender wants or the investor wants to have some kind of security based on the parameters. So we're going to have lower LTVs, although we can go even up to 80%. We're going to have good FICOs and good assets. Okay. So, again, as you can see, point 3, focus on LTV, FICO, and liquidity. There's no DTI because we're not calculating any income or anything like that. No tax returns, no W-2s, nothing is required. In some cases, the lender will ask the borrower to sign a 4506, but they will not execute it unless the loan goes into default. I want to bring that up because that comes up a lot when we do a no doc loan. When the lender, the borrower receives their disclosure, there's a 4506 tax form in there, meaning that the 4506 is the lender sends that to IRS to get the tax information for that specific borrower based on their name and social security number. On the no doc loan, the 4506 is included in the disclosures, but it's not executed unless the loan goes into first or second payment default. Okay? So the no doc loan is only available for owner-occupied and second home. It's not available on investment. And so hope that answers your question. We can go up to 80%. That's pretty good. So someone has 20% down payment. They could get a no doc loan. And minimum FICO is 640. Excuse me. And the reserve requirements are based on the FICO. They could be as low as 3 months or as high as 24 months. So again, the investors in this case are looking for a solid borrower. And what is the solid borrower for a no doc file? Good FICO, good assets. So it's very simple. It's a very simple loan. It's available for primary and second homes only. One of the good things about this program is actually if a borrower is out of bankruptcy one day, you could be out of bankruptcy today, and we could start your loan process tomorrow. Okay? So that's one good thing on this one. Maximum loan amount up to $3 million. And here's the other thing. Let's say the borrower doesn't have the 20% and they're going to get a gift. Everything, include all that 20% could be a gift. 100% of the down payment could be a gift. Okay? So that's another advantage of this program. Now, who is this product good for? Of course, the first and foremost is the self-employed borrower, especially for those, if you're in a cash-based business, that's ideally for you. If you had a recent bankruptcy or and it was settled and stuff, so that's for you. Like I said, you could be settled yesterday, and we could start your loan process today. People who are seasonal workers and recent immigration, they have green card, they've brought in money with them, but they don't have the employment to show. So I actually just did just last couple of months ago, someone from Mongolia, they had just migrated in, they had the green card, they had the cash, they had brought in a lot of money with them. The money was sitting in the bank. They bought a house with 20% down, no doc, and they're happy. Again, and these loans, the rate's going to be a little bit higher, but these are they're temporary loans until you want to refinance down the line after a year or two to get you, once you plan ahead to do other things. And of course, for retired people. All right. The next one that we use some, and it's not a big market, it's called limited doc loans. This is mostly for, I did put salaried borrowers here. If you're salaried, you could use it. But if you're self-employed, this is ideally for you. Also, it gets you a little better pricing than the no doc if certain parameters are met. And basically, if you're self-employed, you are providing self-prepared profit and loss statement for your business, and we also need to get a CPA or tax preparer letter stating that you're self-employed, you own the percentage of the business, and how long you've been in the business. You have to be 2 years self-employed for this program. Again, the rates, I usually price borrowers on this program if they're self-employed and no doc, depending on which direction we want to go. It's a very good program. It's available out there. Again, we can go up to 80%. Minimum FICO is 640, but the rate's going to be a little bit higher on the lower the FICO. On this one also, 100% gift is allowed. Everything, all the down payment could be a gift. And the other good thing on this one is if the borrower is using this, is doing a refinance as cash out, the cash out amount can be used as reserves. So the program, for example, just to give you an idea, at 660, the program, let's say, requires 12 months of reserves, and you don't have that reserve. So if you're doing a cash out and you're getting, let's say, $200,000 cash out, and 12 months of reserve is about $35,000, you could use that cash out can be used for reserves. You don't have to put that cash out on a separate account or anything like that. That's just automatically qualifies for reserves. Okay, and it's only available for primary and second homes. The last program that I want to cover is the DSCR loans, meaning debt service coverage loan. These are for investment properties. Basically what it is the current rent. Let's say if you're doing a purchase, the rent based on the appraisal report on the 1007, it has to cover principal, interest, tax, insurance. If there's HOA as well. Okay, so we do have programs that if the rent doesn't cover the PITI and HOA, we do have programs for those as well, but the rates are much higher on those. Ideally, you want to have the rent cover the PITI and HOA, and most of the time it does. Okay, now these are investment type of properties, so they do have prepayment. Okay, and going on forward, I have to change this slide here where it says only 15% down. That actually where the market is right now. It has to go. It's minimum 20% down. Okay, that was changed recently. Again, remember I said the market is going through its calculation and changes. We are in a state of shock right now, but that's normal. So not us. I mean the rate market, the bond market, in a state of shock. So minimum FICO is 640. Again, on this one, 100% of the down payment could be a gift. So I don't know if you understand that. So it's important to plan that section. If, for example, you have certain amount of money and you need to deposit that into your account for down payment, you can't deposit it today and show that you're going to be buying tomorrow, right? You need to source that and season that, correct? So how do you plan that? There's a way to do that, and if you're interested, email me. I'll be more than happy to discuss that. So this area, the gift fund or the funds brought to escrow or down payment, that creates a lot of problem as a borrower because the borrowers are not educated. They're not given the education on how to do that, and unfortunately, that creates a lot of issues throughout the process. So if you're in the market to purchase a property and you need some advice on that, please reach out. We'll be more than happy to guide you accordingly. Okay. This program is available on single family residence, 1 to 4 units. In fact, all the way to 5 to 8 units properties. Okay. And first time home buyers are eligible. Let's say if you're renting right now at one place and you want to purchase another property for investment purposes, you can do it. There's some restrictions that we need to provide documentations for, but if we pass those restrictions with proper documentation, then you're able to do it. Okay. Let me see if I received my pricing scenario. Give me 1 sec. In the meantime, if you guys have any questions, you could just type it in and I'll come to it in a few minutes or seconds. Yeah, I don't see the pricing, unfortunately. But in terms of pricing, you are, for a scenario like this, for example, purchase price $1 million, 20% down payment, 720 FICO, LA County, single family residence. On a bank statement program, you're going to be around, in fact, I have the old prices here. You're going to be around, these are, again, don't quote these rates because these are old. They did not change it. You're going to add at least 1.5 points or so on these. So you're going to be between 7 to 8% area on a bank statement. On a DSCR, depending on the parameters, 6.75 is still doable. 6.5 and up, I would say. And on the limited doc, it's going to be around in 7s. So they're still pretty decent given the market change. These rates, just so you guys know, 5.75. These were about, I would say about 2 months ago. So it's changed a little bit. Gilbert, yeah, definitely. I could email you if you send me an email with your request. I will definitely send you some information on the programs. One of the other things I wanted to quickly cover, we are licensed in California, Washington, Florida, Texas, and those are 4 states. Although on the DSCR program, this program, we can do in all 50 states, okay? But regular loans, we are licensed in 4 states currently. We are adding North Carolina and a couple of other states soon. And if you guys have any questions, again, feel free to call me or email me. I appreciate and I thank you for joining me today. I mean, you took an hour of your time. I respect that. And I hope I added some value to your knowledge. All right. Thanks again. Have a good afternoon.